Okay, I said I did. All right, so the promissory note. Anytime you take out any kind of loan. Now, this is not credit cards, but this is loans. Student loan, house loan, car loan, any loan. Even if you go and get one of those payday cash advance loans, you are signing a promissory note. That Federal Truth in Lending Act that I had mentioned is the federal guidelines for the promissory note. And the promissory note has to have every single aspect of the loan on it. So the repayment terms, the interest rate, whether or not that interest rate can change, how long the loan is, what the total amount of the loan is for, what the total finance charges on the loan are going to be. If there is a prepayment penalty or prepayment privilege, which we'll talk about later, but like every single detail, if it is not on that promissory note, it cannot happen. And before you sign the promissory note, you actually want to read it because it is a legally binding contract. Once your signature is on it, you are bound by whatever those qualifications, characteristics, rules, everything that's in the promissory note. So you really don't want to sign that without reading it first because you are legally bound to it once you've signed it. The principal is the money that you've borrowed. The annual percentage rate is the interest rate that you pay per year or that you're charged per year on the balance of your loan. If you get a cosigner is agreeing to pay back the loan if you cannot. It's a really big deal to ask someone to be a cosigner because you're asking them to take over your debt if you cannot pay it. So if you do get a cosigner, keep that in mind that when you're paying bill or you're paying your loan, that if you don't pay it, they're going to be legally required to pay it. So just, co-signing is a big deal. People tend not to think of it as such a big deal, but it really is. It's a big deal because they're saying, I'll take this person's debt if they can't do it. So that's a big deal. Life insurance. Some creditors require you to have life insurance if you are borrowing from them, and that is so that should you die, the life insurance will pay your debt. And that's kind of how things work. When someone passes away, all their assets go to pay off their debt first before any inheritances or anything get passed down. So some creditors do require life insurance for that purpose. Okay, prepayment privilege occurs when you are allowed why is my pen being weird? So we have there's prepayment privilege or prepayment penalty. You will have one or the other of these on your loan. The prepayment privilege allows you to make early payments in order to reduce the total amount of interest you're paying. And the prepayment penalty is if you pay off your loan before the due date, then you're charged a fee. And this is because if you pay it off early, then it reduces the amount of interest you're paying, and so the lender doesn't earn as much money off of you, so they'll charge a fee. The way interest works out is that every single month it's recalculated based on the current amount you owe. So if you're making larger payments to pay things off earlier, you're getting charged less interest every month. And then, of course, when you pay it off early, all those months early that you've paid it off, there will be no interest. So that's why some places charge a prepayment penalty to kind of recoup some of that money that they lose. This will not be on every loan. Like, some may have a privilege, some may have a penalty. Unless it said so in the promissory note, you have the privilege. They have to tell you if there's a penalty in the promissory note, or else they can't charge you one. Okay, then there's wage assessments versus wage garnishment. A wage assessment is voluntary. That is when you choose to have a portion of your paycheck taken out before you get it, sort of like direct deposit, except it gets direct deposited to your creditor instead of direct deposited to you. It's voluntary. Your creditor and your employer have to agree on this. Must is not spelled with a Y. That's okay. You should always tell me when I misspell things.
The wage assessment, is that really used a lot anymore because there's auto pay?
Not a whole lot. Probably not a lot, but it is still possible to have it. I would say though that it's probably more likely to just come straight out of your bank account, like you said, with the auto pay. Now, a wage garnishment is still used pretty frequently, and garnishments are involuntary wage deductions. So you have been ordered by the court because you've been sued, or like child support gets garnished from wages a lot, taxes, things like that. And so these are involuntary wage deductions. Usually they're accompanied by a court order. And your employer does not have a choice. If you've been ordered wage garnishment, they have to do it. Like on the wage assessment, the employer can say yes or no to that because that's a voluntary thing and you're asking them to do extra paperwork. But on a wage garnishment, that's like a legal thing. So they have to do it. Wage garnishments are not good. They look really bad because, like I said, usually it's a court order and it's usually because something was done incorrectly. Balloon payments. Sometimes on your mortgage or even on your car loan, any kind of loan, the payments, let's say you pay $300 a month. And if you split the loan up, it doesn't even out equally. And so sometimes that last payment will be larger. It might be like one or two, maybe 1.5 payments instead of just one payment because they don't want the half payment like the next month. They'll just put it all together. And so sometimes it'll be slightly larger, the last payment, but sometimes it can be really, really big. You can have what's called an interest-only loan, where during the term of your loan, all you're paying is interest, and then your last payment is all the principal. So that last payment can be thousands of dollars. So it really depends on the setup of the loan. But again, if you're going to have a balloon payment, that has to be mentioned in that promissory note. If it's not in the promissory note, it can't happen. Yeah, they'll know up ahead. Yeah, they have to tell you. They're legally required to tell you. Yes, and they know that when you get a loan, especially nowadays with all the computer programs that are available for the banks and stuff, they can give you a list of. I mean, even if it's a 35-year mortgage, they can give you a piece of paper, well, a stack of paper with every single month of that mortgage and every single payment, exactly how much of it's principal, exactly how much of it's interest, what your balance will be at the end of it, and if there's what your final payment will be. They know that on the day you get the loan. Now, typically they don't give you all of that, but if you ask for it, they can give that to you. But they know every single aspect of the loan the day you have it. So they have to tell you if there's a balloon payment or not. All right, so lending institutions there's a lot of different lending institutions. There are banks, there are credit unions, there are consumer finance companies, life insurance companies, loan sharks. Just kidding, those aren't lending institutions. Any business, organization that extends loans and they make their profit via interest rates. Banks are the most common. You have savings banks and commercial banks. Savings banks are your general banks that you see: Bank of America, Wells Fargo, Chase, Fifth Third. I hate that bank. Just because of the fraction. It's not Fifth Third. There's no such thing as Fifth Third. It's 5/3. But it's my math nerdiness. Anyway. Yeah, it drives me nuts. There's no such number as Fifth Third. No, it doesn't work. But they don't have the in front of it though. It's just Fifth Third, which is not. No, it's bad. Mm-mm. Anyway, it's a bank. They've got tons of money. These are savings banks. And then you have commercial banks. Commercial banks are for businesses only. Now, some banks, for example, say Bank of America, has a savings bank and a commercial division. They do both. Some are one or the other. With a bank, you do have to have a good credit. You will get a decent interest rate. Interest rates are regulated by the Federal Reserve Bank, when you're talking with banks, and so you'll get a better interest rate because of that. Credit unions are members only. Membership requirements vary depending on the credit union. Some of them just require you to live in a geographical area. Some of them require you have a certain type of job. It just depends. Most of them are sort of opening up more that if you live in the area. Like, for example, Central Florida Federal Educators Credit Union. It's for teachers originally, but now if you live in Orange or Seminole County, you can get an account there, period. You don't have to be a teacher. So, no. Credit union is basically like a bank, except with a bank is a corporation. A credit union is owned by the members. So that's really the difference. It's not a private company. It's a member-owned bank, basically. Because of that, you get much lower interest rates when you're being charged interest, and you get higher interest rates when you're being paid interest. Then you have consumer finance companies. These places will lend money to people with bad credit, but they charge very high interest rates. Check cashing places, payday loans, any kind of bad credit loan company. It's not a bank, it's just a loan company. It falls under this category. And then you have life insurance companies, and they only make loans to people that have whole life insurance. There's whole life and term life. Term life is that I make a monthly payment, and if I stop paying, I no longer have life insurance. The monthly payments are much lower with term life. With whole life insurance, you build equity. So if you miss a payment, you still have the policy because you've put money into it. And you can borrow against a whole life policy. Now, the monthly payments on whole life are higher, but when you're 80 and you're retired, you can cash it in and have your money. You don't actually have to die. With term life, it's only if you pass away that your descendants get it. But you can borrow money on your own life insurance policy. If you have whole life insurance, the interest rate is really low because you're borrowing your own money. So these are the lowest interest rates possible. Pawn shops. You guys have all seen Pawn Stars, right? And you guys have all seen how the guy comes in, that like the expert on the painting or whatever, the sword or whatever, and goes, "Oh yeah, that's worth like $4,000," and then they go, "I'll give you $100 for it." That is how pawn shops work. You take in your item and you can sell it or you can pawn it. If you sell it, you get a little bit more than if you just pawn it. If you pawn it, if you sell it, you get less. If you pawn it, you get a little bit more, but you're expected to pay back the money. But you don't get anywhere near the value of the thing that you take in. If you take in a watch that's $200, you're going to get like $40 for it. Maybe. They usually give you 20 to 30% of the value of the items that you bring in. So, if it's an emergency situation, I can't say not to do it, but I don't recommend that you ever do this. Well, pawning, you get your stuff back in theory. Like, you can go get it back after 30 to 90 days is the maximum, but you could give them back their money plus interest, and then you get your stuff back. They can't sell it until the term is done. So like if you have a 90-day loan with them, they have to hold it for 90 days. They cannot sell it, but on 91 days they can sell it. So you can't be late. So that's how that works. Again, emergency only. Or somebody gives you something that's very expensive but really hideous and you just want to get rid of it, go ahead. That kind of thing. But no, I'm saying they bought it for you.
We did go over the vocabulary already, so that's posted from yesterday, and I'm going to splice the two videos from yesterday and today together. This is the formula that is used to calculate the monthly payment. No. It's really not, no. Because of the way monthly payments work with interest, so it's not, when you buy a car or a house or whatever, okay, I know of Volkswagen uses simple interest to do their calculations. And so when Volkswagen figures out, if you get Volkswagen financing, they take the amount of the car, they multiply it by the interest rate, by the number of years of the loan, they add that to the total of the car, and they divide it by 72 or whatever. Okay, but as far as, to my knowledge, I mean, I don't obviously know the knowledge or the practices of every single bank and every single company out there, but to my knowledge, Volkswagen is the only one I know of that uses simple interest in their loan calculations. Everybody else, what happens is you buy the car for $10,000. You make your first month's payment, and the interest is calculated on the $10,000 you owe. Then you make a payment, and it goes down to, like, say, $9,902 or something. Then they calculate the interest the next month on that new balance. And every month you get calculated on a new balance. And so the payment amount, the total payment stays the same, but at the beginning of the loan, the majority of the payment is interest, and at the end of the loan, the majority of the payment is principal. So to figure out the monthly payment amount that will work to encompass all of that interest, this is the formula that they use. So R is your rate as a decimal. P is the amount of the loan. And T is time in years, the length of the loan. Now on the next page, I'm giving you guys a table, and there are monthly loan calculation tables, and we're going to use this for some loans, but the calculation tables only work if you have even thousands of dollars. So if you borrow $10,000, $5,000, $20,000, $25,000, things like that. But if you borrow $23.75, it doesn't work, and you have to use this formula. So you'll have the two options. You can use the table for the even thousands, and you'll use this formula for the uneven amounts. Okay. Monthly payment per thousand table. This particular table goes between 6.5% to 13.25%. It's a shortened table. There are tables obviously in existence that go all the way from like maybe 0.25% to 30 or 40 or 50% or something like that. But this table goes between 6.5 and 13.25, and it's in quarter increments. So just like you can only use the table if you've got even thousands, you can only use the table if your percentage rate matches one of these. So for example, if I had 7.3%, I can't use the table. Okay. So if we look at our next example, I have $4,000, 2-year loan, 8.5%. Okay, 8.5% is here, 2-year loan is here. Okay, this amount where those two things meet, this is the payment per 1,000. Okay, so for every $1,000 you borrow, you owe $45, $46 a month. So it's 45 per 1,000. Does that show up okay? Okay. So we're borrowing 4,000s. There's 4 of them. So we take that 4546 and we multiply it by 4. And so our monthly payment would be $181.84 every month. So again, to use that table, you need an interest rate that falls on the table. You need even thousands, and you need the years, 1, 2, 3, 4, 5, or 10. Any other amount won't work. So you can't take like a 30-year loan and then take this number and multiply it or divide it by 3 or something. That doesn't work. It can only work for the 10-year loan. Okay, then to find out the total amount of the monthly payments, we take that $181.84. It's a 2-year loan, so there's 24 months there. So that's going to be 24 payments. So we multiply this by 24. And the total amount of the payments will be $4,364.16. To find out the finance charge, we take that amount that we just calculated. We subtract the original value of the loan. That's the interest or finance charge. So when we have nice even thousands, the table is great. And you have the table here in your notes, so when you're doing your homework, you can use the table. As long as you have even thousands, the right time length, and the right percentages. But here in this example, the first issue we're going to have is this is nowhere near anywhere close to an even thousands. He's borrowing $28,716 to buy a car. 4-year loan, 5.12%. Not even percents, because on the table it goes by quarters. So we're going to have to use the monthly payment formula on this one, which is so R is 5.12%, so that's 0.0512. T is 4, and this is P. Right, so 28716 times 0.0512 divided by 12 times 1 plus 0.0512 divided by 12 and 4 years. And then I have 1 plus 0.0512 divided by 12 to the 12 times 4 again, minus 1. Okay, calculating all this, 12 times 4 is 48. That one's pretty quick to fill in. So I get 28716 times 0.0512 divided by 12 is 0.004267. And then I have 1 plus that. And then I also have 1 plus that down here. Okay, then the next step is to raise this to the power of 48. So I'm going to do that first, then multiply, then multiply. when I do that, I get 150, 31 over, raise this to the power of 48, and then subtract. And that gives me 0.226745034, which gives me a monthly payment of $662.97. Okay, so monthly payment is $662.97, and that's 4 years. If we were now asked to find the total interest or find the finance charge, we have to take that payment. 4 years is 48 months. So I need to multiply that by 48. So it's $31,822.56 is the total paid. Okay, now that's because we did a short-term loan, which made it a higher payment. Just for comparison, if we did a 6-year loan, okay, which most car, when you buy a brand new car, you get offered a 6-year loan. It gives you a lower payment. So let me just do the calculation really quickly. 6-year loan instead of a 4-year loan on this car. It's going to reduce your payment by $200 a month, which makes it very tempting, right? Like, I could save $200 a month. But watch what happens to how much you pay for the car. Instead of paying $31,000, you're paying $33,000. So instead of paying $3,000 in interest, you're paying almost $5,000 in interest. Identical interest rate, identical amount of the loan, but that extension of 2 years costs you almost $2,000 in extra interest. And the reason I wanted to do this is because if you can afford the higher payment, and that's a decision you need to make with your budget and knowing what you can afford to fit into your budget. But if you can afford the higher payment to do the shorter loan, be it a car or a house or anything, you save a lot of money in interest. And we're going to do a problem in this chapter on a mortgage, and it's ridiculous the amount of money you save. Okay. Okay, so yes, there are these formula or these calculators on the internet. Now, however, not every single one of these calculators is necessarily accurate. If you go to like a bank website and use one of their loan calculators, it is probably pretty accurate. If you just Google loan calculator and end up on, you know, some Joe, Billy, Bob's Loans R Us page or something, I can't guarantee that their calculator is going to work well. Okay, so, you know, look at the source to determine if you think it's a reputable, accurate calculator. Better yet, just do the math yourself. So we're going to determine the interest on a 5-year, $10,000 loan at a 6% APR. Now, if you're going to do this on the homework, you could use the table, or you could use the formula. Oh no, you can't use the table. I'm sorry, the table doesn't go back to it starts at 6.5. I lied. You have to use the formula. If this was 6.5, you could use the table. So we're going to put in our $10,000. I didn't mean to lie. Uh, 5 years. And normally what I do is I go in and I say, okay, that's 60. And I replace those. Then I might come in after that and do the 0.06 divided by 12, which is going to be 0.005. And I do those. Then I'll do 1.005. I raise it to the power of 60. I multiply that by 0.005, which I multiply by 10,000. Then I take 1.005 again and raise it to the power of 60 and then subtract 1 from it for the denominator. Then I divide those two things and get my monthly payment. Okay. Now, my question was not the monthly payment, but the question was, what's the total interest owed? Okay, so that's the monthly. I'm going to do my interest calculations over here. I'm going to take that 193.33, and it's 5 years, so it's 60 payments. And if you ever wonder what number to multiply by, it's always going to be that number right there, 12T. So 193.33 times 60 is $11,599 paid, minus $10,000 gives me $1,599.80 interest. Like on a car loan, the longest anybody will ever go out on a car loan is like 84 months, which is 7 years. That's rare though. Usually they won't go past the 72 months, which is the 6-year mark, and that's usually only on cars that are 1 or 2 years or new. And the reason being is because cars depreciate so quickly, and as we all know, they're built to break down eventually. They're just going to break down, and the banks don't want to gamble on if they make the loan period too long and then the lifetime of the car is shorter than the loan period and the car's dead on the side of the road. You have no, why would you pay for it anymore? Like, okay, you want to repossess it? Cool, that'll save me the towing. Go get it. So they don't want the loans to go out really long on a car. So there's a delicate thing there, like they'll try to fit it into what you can afford, and they'll determine how long the loan has to be, but sometimes they can't make it work. This is the formula to find out how long a loan needs to be based on what you can afford to pay. Okay, it's the loan length formula. Now T is the years. Okay. M, these should both be the same M, not one capital. Yeah. The M, I don't know why I did one capital, one lowercase. They're both the same. This is the monthly payment you want. is the total amount of the loan. And then R is the interest rate as a decimal again. Now this thing that you guys have not seen before, ln. Okay. ln is the natural log. Okay, and it's logarithms are a mathematical operation. And I'm not going to get into all the different things about logarithms right now. You'd learn that in Algebra 2 or pre-calc or calculus if you take it in college or whatever. What I will tell you is that natural log is a button on your calculator. Okay, it's ln. If you're using my TI, it's the third button down here on the left. If you're using a scientific calculator, like say for example on the computer, it's this button right here. Okay. And okay, so on this particular calculator, you have to put the number in first and then hit natural log. On the TIs, you hit natural log first and then it gives you parentheses. You enter the number and close the parentheses. So I'm going to pull that up really quickly so you guys can see what I'm talking about. Hold on one sec. So we've got this natural log button. So what we're going to do is we're going to figure out how long Claude's loan has to be. He wants to borrow $25,000, that's P. $300 a month is M. 5.9% is R. Yes. Yes. Yeah. Okay, so what I'm going to do now, this is 12 times the natural log. Okay, so I have to divide first, then take the natural log of the number. Here I have to divide, subtract, and then take the natural log of the number. Okay? And then here I have to divide, add, take the natural log, and then multiply by 12. So it's very specific the order we have to do these things. So I'm going to write this out the long way to start. So I'm going to take 300 and I'm going to divide it by 25,000. Ooh. Helps if I hit the right button. So 0.059 divided by 12. That's a 1/6 repeating. Two zeros. Okay. Then I'm going to do this subtraction. Oh, it's probably not a good. 0.012 minus, that answer gives me 0.00708 with a repeating 3. Okay, so that's that subtraction right there. Next, I'm going to take the natural log of 0.012. So actually, I'll do that on this calculator so you guys can see. No, this is just the subtraction. Yeah, so that's this part. It'll be on mine. You're welcome. You too. Okay, so I did that subtraction. So I'm going to take the natural log of 0.012 natural log. So it's negative 4.4228 minus, and then I'm going to do 0.007083 natural log. So negative 4.95, I'm just going to do 0.95. Now, this minus and negative is really important. Don't drop out one of those negatives because that'll make a huge difference. And then I take the natural log of 1 point, here, hold on, add those together. Wow. That's 1.004916, right? So I'm going to take 1.004916 natural log. And I have 0.0049. So far, okay? Double negative becomes a positive, so that is negative 4.4228 plus 4.95, and then 12 times 0.0049 is 0.0588. So that's 0.5272 divided by 0.0588. And I have 8.96 or 9 years. Okay, so in order to get this $25,000 car for $300 a month, it would have to be a 9-year loan. They wouldn't. Do you have to write out all of this steps? No, I wrote it out the long way so that you guys could see the whole process. You can do the same thing that we normally do, which is, go through here and do this, divide that, subtract it, take the natural log, write it down. Divide this, take the natural log, write it down. Divide this, add it, take the natural log, multiply it by 12, write it down. I mean, you can skip all the writing. Does that make sense?